Good morning to those HLB community members that have joined us again for our weekly update. Thanks for doing so, and remember that we're all here. You can call us or email us anytime in between these presentations. We're always accessible, so please don't hesitate in need. All of you, no doubt, have got your winter woolies on today. Hopefully this won't be the winter of discontent, but absolutely certainly we're starting to feel winter coming along now, so we've got to be even more careful to stop the lurgy catching us. Hope you're all well. We've got our usual panel of experts. Todd Gammel, who's going to give us a bit of an update on coming out of hibernation and starting up and how to manage that risk. Peter, who's going to again update us on JobKeeper. Nick Noonan from Henry William, who will talk about stand downs and give us a bit more information on what he's seeing coming out in practice vis-a-vis what the legislation is telling us. And Betty, who will give us her usual funding and bank update with some anecdotes. Please bear with Betty. She's got a bit of a sore throat today, so she's going to take it easy, but we should get there, shouldn't we, Betty? So I'll hand over to Todd now.
Thanks, Tony. Afternoon all. Yeah, it is cold even down here in God's country in the Shire. So I thought I'd take you through a little bit of an update of further where we were last week and what we're seeing with our market, and particularly with everybody now looking to expand and extend into what their plan is going forward. Basically, what we talked about last week is now everybody is really seeing that there is a return going to happen in the next few weeks, and they're going to have to transition along holding JobKeeper together and looking at their incentives to go back, effectively continue to operate. So there's a lot of premises that are considering how they reopen and where rent sits. I suspect that a testing period over the next 2 months while things gradually reopen. There's notifications going around like the banks identifying that they're probably going to split their teams and only 50% of their workforce will be in the office, the rest working from home. That will slow down demand for things like food and whatever else around the city and other hubs. So that will make it more difficult for the economy to recover quickly, but there will be a continuing demand similar to what we've seen recently around certain aspects like Bunnings and Flower Power and whatever else, Officeworks, for those things to ensure people can work from home and are distracted by other aspects. So that's going to drive a lot of the economy, I think, over the next few months, and there will be then an uptick or a gradual uptick in retail. What that looks like, who knows? There's a new normal that will come through with that. Private equity are getting very aggressive at the moment. They're looking for opportunities. We're working on a couple of deals where there's 4 or 5 term sheets out on some of these jobs, and they're starting to even contemplate clubbing together to get deals done because they need to, and that's starting at the top with Virgin. There's obviously 5 or 6 private equity guys looking at that. The only issue with private equity is they obviously look for a 2 or 3 year window to be able to make their money. It's not necessarily a longer term play like another trade buyer would. So there's going to be interesting to see how a number of these play out. It may well be that these are holding patterns for some of these businesses, and once things have stabilised in 2 to 3 years, there will be another transaction or a buyout or a listing process to exit the private equity. In terms of the practical adjustment, I sat on a call for about an hour trying to work out how things in this business would operate under social distancing for the next 18 months. It's safe to say there's a lot of measuring going on and a lot of trying to work out how it all fits. And apparently it's very difficult to get sneeze guards very quickly now because everybody's ordering them to be able to protect their own staff. But I think everybody is working through that structure, and there needs to be almost a checklist. I think for some of the smaller retailers and cafes and things like that, there may well be a checklist that you have to agree to sort of come in and understand it. So you'll walk in and say, these are the rules of engagement here. before you can get through. But once people get more familiar with that, that'll become just the normal process. The other thing of that is obviously it's going to change cost structure. Whether this party was looking at more staff to be able to deal with people who are separated rather than a condensed place, and almost have a sort of table service like business, even though they're not a cafe, but to try and have it that, and floating desks to be able to do it, similar to, say, some of the banks have those floating desks in their branches, and then thinking about how much it's going to cost them to get through that initial phase where revenue is going to be a bit short, and costs will be probably returning wages, obviously with some JobKeeper compensation, and rent at a reduced level and whatever else. So working through those, getting that cash flow sort of sorted, and understanding how those practical issues. There is a little bit of capex required for a couple of people that we've talked to, and they're talking to their banks about funding it. And one of them has had a positive response. It's like, well, if you need that to trade, well, let's talk about that and put that on terms. So people are working together, and that's one of the positives out of it. I think people are actually willing to look at it and understand they've got to communicate around it. The other thing is there's plenty of space available for lease. I think that's going to be one of the shakeouts it's going to have. Landlords are probably going to have to reset, look at how they are going to lease it, and businesses are going to be looking at their space differently as well. I know we are, as a firm, having two and a half floors in a major building in the city. We're considering how we use that, given we're only using about 15% at the moment. And I think our average age in the office has gone beyond 60 because of that. So it will be an adaptive sort of process going forward. The other thing we're seeing is a lot of mergers being contemplated, where people are either needing parties to come and help them adjust, or they want to reduce costs and reduce overheads, so that they can actually make this work going forward. And there's a couple of parties who've been able to automate and bring their systems up so that they can actually operate without having interaction. So one party we're talking to is looking at more staff to be able to handle the people who are going to be floating around inside their premises, and another party is looking at automating it to almost go to a McDonald's style where you can walk in and order what you want. So it's different. Everybody's having a different approach. And then there's a lot of retraining and consideration of what staff you have and whether the staff are right. So all of those things are playing out. But I think the green shoots are there, and the good news is that I think by spring there'll be a balanced sort of approach. We obviously, travel overseas will not be something that's considered until next year. And talking to a few people who operate out of businesses out of the airport and subsidiary businesses out of that, they're not expecting international to come back online in any sort of volume until the back end of next year. Local travel is expected to sort of jack up probably, I suspect, after the July school holidays. And Queensland's expected to be a pretty attractive option for a lot of people who can't go to Bali and anywhere warmer. So those businesses are getting ready for that. But it's going to be a long, hard slog before they get to any increase in business, and there's probably going to be a volume excess as well. So how that part of the economy shakes out that extra volume and those extra resources, so all those people who work around that industry, where they all get redirected to, well, that'll be interesting to see. But hopefully that means Melbourne Cup is not in danger, and we'll be able to enjoy it, albeit with probably smaller functions, and not being able to invade a pub or a club where there's 150 people jammed into a room that holds 120. It'll be a new structure, a new process. So there's some good positive signs. We've just got to think about it and plan about it. And those who are looking at it as an opportunity, I think, are getting more excited about that rather than the people who are looking at it as an arduous task. And that's about it for me, Tony.
Nice to finish on a positive note. Thanks, Todd.
Yep.
Peter, maybe you'd like to give us some updates on JobKeeper, and it's been extended now to the end of May, and some of the things that you're talking to clients about. take yourself off mute, Peter.
I will unmute firstly. Thanks, Tony. And yes, it is a little bit chilly up here in the northern beaches as well, Todd. So yes, what would we do with ourselves if we didn't have JobKeeper to occupy our time at the moment? It's certainly been all-encompassing, but interesting. I was interested to note that those of you who maybe get the accountant's daily updates, there was something from the Treasury officials that have been grilled by a Senate committee or some such thing, where the general comment is that they don't see too many more changes to JobKeeper. They're feeling like maybe we've had enough major changes. So the one priority that they still say they're working on is to do with service entities, which of course would be of interest to a lot of accounting practices and law firms and other. I don't know that I've got certainly got clients that are other business type clients that are that's of interest as well. So we since we spoke, in fact, that's one thing that's changed since we spoke last Friday. I saw that as being a major problem area. Well, they fixed that over the weekend. So I'm fairly relaxed on that front because the announcement by the Treasurer is that will be resolved. But we'll see some detail. So hopefully by Monday or early next week anyway, we'll get a bit of detail that'll just flesh that out. But it seems like there's not too many more changes coming. So as you say, Tony, one of the more recent things in the last few days is extension until 31 May. So again, we were speaking last Friday about deadlines and looming deadlines. So 30th of yesterday was obviously a pretty short, pretty tight deadline. So to actually register everybody, evaluate, make all your pay all your employees, including top-up payments where required. To do all of that by yesterday was a pretty tough ask. So the extensions we have, as I'm sure you all have heard, is 31 May to finalise the registrations for if they want to be paid for April. So for businesses that are still evaluating that and working out whether they qualify. Although what we're finding is that people still wanted, obviously there wouldn't be too many people that want to wait till 31 May because at this stage now that the applications can be made, the sooner you get the applications in, the sooner you actually get your money. So we're going to start to see that sort of flow through, and I guess we'll probably start to become familiar with the actual the process of how it all applies in terms of the reporting, and it will be interesting when we first see the first payments come through. The other extension, the 8th of May. So again, to make top-up payments by just another week or so which would be for people, probably a couple of the obvious area was where staff are paid perhaps on low rates or low hours, so they're paid less than $1,500 a fortnight for those first couple of fortnights to top up to $1,500. We've now got until the 8th of May to do that if you're going to be in the system from the beginning. That would also apply for people, and again, Nick might make any comments about stand-down arrangements, but for people on stand-down arrangements, again, I guess to make sure that all those people have been paid, then I guess 8th of May is the deadline to just bring everything up to date, and then from then on, it'll get into more of a normal routine in line with the payroll procedures, and there's all the things to do with single touch payroll and how things are reported then. So timing wise, they're the main things that have changed. In addition to service entities, which again I'll just touch on in a second, in a bit more detail, but one of the other changes, and you may have seen a few articles on this as well, is to remove the eligibility for 16, 17-year-olds unless they're financially independent. So the stories about someone that works one shift a week and is suddenly I read an article earlier where some of those students were going to have their pay times by 4 or 5 or 6 times to get them up to $1,500 a fortnight. And that just, so the reckon is that just didn't make sense. Unless they're actually independent and supporting themselves, then obviously they can be paid, but otherwise those won't be eligible. But that's a prospective change from the announcement. So there'll be a few people who would have actually got those payments through April, but then going forward they won't. So I don't think there's too much else. I don't think there's actually too much else on that slide. And obviously we'll take any questions as we go along here. And we touched on, okay, so we touched on the alternative, the alternative methodologies that had been announced Thursday last week. Had the chance probably to look a bit more closely at it for again, a couple of client scenarios. So I think we've got a slide that's setting out a bit further on, setting out the various tests. But this is probably something again we're starting to see as we look at practical examples as to people that where employers that wouldn't otherwise have got in because there just wasn't a comparable period. Then there's the various requirements, and we can just go through them all. That the ATO at least has the power, not in relation to only where there isn't a comparable period. The ATO power the ATO has made it clear that their power is fairly relatively limited in where they can provide alternatives to the basic turnover test requirements. But where there is no comparable period for a variety of reasons, then these 7 alternative scenarios have been mapped out. And I think I mentioned last week that the service entity arrangements was not, I mean, that wouldn't, there is a comparable period, it's just that it didn't fit within the rules. So that's a change that had to be made by Treasury, not by the ATO. So hence why the Treasurer is the one that made the announcement over the weekend that change would be made. And so we'll see early next week, we should see a legislative instrument and some updates to the ATO, to the Treasury fact sheets on that. But this stuff is coming from the ATO. So I think that's all I had to say on that. Sorry, I'll just say one question. I should address maybe Mark's question as we're going through this. So Mark's asked a question, are we expecting to see the monthly declaration online 4th of May? Will there be functionality for non-STP businesses? So yes, well, I understood that 4th of May was the timing for forms. But yes, I think there is, I think it's on the ATO website, they talk about, Mark, they talk about non-STP businesses. So how that exactly, beyond what's on the ATO website, there may not, some of that may not be completely clear, but I think probably to the extent that the ATO website doesn't make that clear, I think we'll probably see a little bit more next week. But certainly the again, as I understand, STPs being catered for, and there's non-STP businesses where there might be need a little bit more, but and deck things can be made through the portal. So when Mark refers to online, I think the business portal would, I think the business portal should provide some. Sorry, I was looking there. Business portal should provide something. As that's where a lot of the reporting should be happening as well. Mark, does that sort of address the question you were raising? Just to see if there's any comment there from Mark. I might just touch on, so just to go through briefly those seven scenarios, just for anyone who hasn't looked at them more closely. Sorry, yeah. So again, just listing down those 7 scenarios. So what the ATO alternative tests were intending to cover was someone who had commenced business before the 1st of March, but after the comparable periods. So that's an obvious one that you can't go back 12 months because they weren't in business at that stage. The second one was where there's been an acquisition or disposal. So that had a significant impact on the entity's turnover. So again, recognition that the business, there's not going back 12 months to make a comparison just isn't valid because there's been an acquisition or disposal. So it just doesn't, it wouldn't gel. So there's discussion in the ATO instrument about how you would look at periods just after the acquisition or disposal to try and to allow a comparison with that period versus the say April 2020, for example. so you're not going back as far, so that it's a more valid comparison. Third one is a restructure, and I was reading that is not, one of the questions there is, well, what is actually a restructure? I read something that suggested that a restructure may well be, I think that was covered in the tax, for those that may get the Tax Institute's weekly update. Bob Deutsch was talking about a few aspects to do with this, and I think he made the comment about a restructure, and I think he was talking about these alternative tests more generally. But his comment about the restructure was, it's unclear what they mean by restructure, but it's probably more likely to mean an internal restructure within the business rather than a specific sort of change in the actual structure or the ownership of the business. But so again, something needs to have happened in the structure of the business anyway, and we don't really have a lot of guidance on what that would be. But those three, anyway, that's another variation on the scenario of where something's changed. The fourth one is, which I've had the chance to look at with a couple of clients, is where there's been a substantial increase in turnover. And I was earlier today trying to explain that over the phone to somebody, and it's a fairly hard thing to probably try and explain without really looking at an example. I think there is at least one or two examples. There are at least one or two examples in the explanatory statement to the ATO's release. But it probably does require just to sit down and think about it. But the gist of that increase in turnover is that where a business has experienced a change, so that essentially the scale of the business has grown quite significantly, so that, for example, they look at a 50% increase over 12 months, and I've heard comments from the ATO where they made it clear that that's a month-on-month comparison. So when you're looking at, say, the month of March versus 19 versus the month of March 20, if turnover has increased by 50%, that's seen as a substantial increase in turnover. And then they say, well, okay, you've gone up. Clearly the business has grown substantially, but then perhaps in April it's fallen off a cliff and you've gone down drastically. So the way that test would be applied is to sort of work out, step one, are you in the test? Step two, then, what's the if you're using March as the comparison, what's the month average, 3-month average up to March 2020? So January, February, March, add those together, divide by 3. That's giving you an idea of what was the state of the business early in this calendar year after the substantial increase, and that'll give you a number which is going to be significantly higher than what it would have been than last year. And then look at what happened in April. And if you can show that 30% reduction from the March quarter average to April, then the ATO will accept that represents a significant change in the business. So that's we're clearly under the basic test. They wouldn't have satisfied it because the business has increased over 12 months, not decreased. And similarly with there's 12.5%, 25% for a 6-month period, 12.5% for a 3-month period. So they're looking at where there's been the business has gone up and then it's crashed, but within the last 12 months. So that's just at least widens the scope of but it's going to really depend on what happened in each particular case. The irregular turnover one is probably not so clear how that will apply. But it's really looking at businesses where something's, again, the basic test doesn't work, so it hasn't gone. You can't look at it having, you can't get that 30% reduction by looking at a point in time over 12 months. But if you looked at what's happened, it's gone up and down quite a bit, so that you can pinpoint periods where it's gone significantly up, significantly down. Then, as long as it's not a seasonal type sort of business, then allows the business to average out and do more of an average and work out, we'll smooth things out. What would the actual turnover have been on an average period, and compare that to what's happened in, say, April. So again, so those first 5, again, they're all looking at different changes in the business. I haven't really looked at so much of the sixth or seventh ones, but again, probably maybe a little bit self-explanatory, you know, where there's, again, something significant has happened to a sole trader or partner in a business that's impacted the business itself. Or the seventh one is the drought or natural disasters. So presumably drought, fire, bushfire in recent years would have been recent months, years would have been what would happen there. So if you can show that that's been had an impact, then there's an alternative test to cater for those situations. I might just return to Mark's question, because I think, Mark, you've said we still haven't, yes, I didn't really give you much explanation of STP, so I can understand that, your comment there. What I've got here. So again, all I can really suggest is that you have a closer look at the HEO website and see what guidance is on there. Otherwise, perhaps look out for what else might come out next week, perhaps, if there's any more guidance. But or the HEO does have a dedicated. I mean, what we've been doing in our office is we've had teams of people looking at queries, and there is a dedicated. The HEO has if you go under JobKeeper in the HEO, there's a section there that they have a dedicated email address for JobKeeper queries. So what we've been doing, we've been sending lots of queries to the HEO, and there's teams of people in the HEO looking at queries and getting back to us with guidance. So I think I would suggest, if you can't see anything on the website that's really giving you guidance on the process, then look for that email address, email them your exact question, and we've been finding that we've been able to get answers to try to guide us on what to do. So I think the HEO is doing what they can to clear up those processes. But so I think probably if we get anything, yeah. So just give that a go, Mark. Sorry, and that's because I don't really have anything more at this stage, but hopefully that helps. All right. So again, I want to keep moving here. So I'll really just touch on the service entity change. I probably won't have too much more to add. So as I probably touched on last week, and I mentioned briefly, the big change that we've got this week, which is this service entity. So if you're an accounting, legal practice, or some other business that has a lot of employees through a service entity, which I'm sure you all know has been perfectly acceptable approach by the ATO for many years, then the obvious problem there is that the employees are in the service entity. The service fee doesn't change, but all the turnover is in a related trading entity, like a company. Then it's just a mismatch, because the rules require you to look at each entity separately. So the testing of the service entity turnover is not going to get you there, and the employees are not in the trading entity. So the simple solution, which has been announced by the Treasurer, is that if something is a pure service entity, then which hopefully in a professional practice it will be. That's what it's there for. The service entity employs the staff and charges a service fee through to the actual practice entities. Then the turnover test will be applied against the turnover of the actual trading entity that deals with the clients or customers, not the and if there's more than one, then they all get aggregated. It's those entities that are using the labour of the service entity employees. So, which seems like a pretty sensible outcome to me, and that should get you there. And certainly my business client that was concerning me, one of our firm's largest clients, that has not just a service trust, but also has a number of companies that are within the tax consolidated group and a GST group that have, and in total they had about 169 out of 199 employees in those service entities. So to get JobKeeper for 30 out of 199 employees was not a satisfactory outcome. And so the end, they've been able to register for all of them, and that should probably make about a $6 million difference to them in terms of JobKeeper payments. So that's over 6 months. So that's a huge adjustment. But even for smaller numbers, it's going to make a big difference to a lot of businesses. So that to me was probably the most significant development, as well as the extensions in the last few days. Not sure. What's the next slide? Sorry, just to. Okay, so how can we help? Well, these are all things that we've been talking about. I suppose the other thing that have been just a discussion point that I've had this morning is, and probably you might have seen the last few days, the ATO has updated their guidance, but perhaps not in a helpful way, on calculating turnover. And they've gone from initially saying, well, cash or accruals will sort of accept either, to now providing probably quite a confusing guidance, as far as I can see, that they generally expect, they've certainly said they don't expect, it doesn't have to be what's on the BAS, but the current statement on the ATO website is that they expect turnover to be along the lines of what's on your BAS. And if you use a different method, for example, if you're a cash and you decide to use accruals or vice versa, they might come knocking and asking questions. So it's not a very satisfactory answer, because they're not saying you can't do it, but they're saying, well, if you do, we'll ask you why. And like, well, what are you supposed to do with that? So I think it's just, you'll be safe if you're fairly safe.
So Pete, it's the same as last week. It's the same
Yeah.
as last week, where you've got to have a plan. You've got to be able to document it.
Correct.
So just make sure you've got supporting docs.
But my problem is, what is the justification? Like, is it normally we typically, in a lot of cases, the part of the answer may be we're doing something to get a better tax outcome, but you're looking for a more commercial, justification. In this case, I'm not sure exactly what that is. And so that's my difficulty with the guidance. It's not clear enough. But yeah, just look at it, and if there's not a lot of difference, but it's just, they do emphasise the comparability too. So the obvious point that whatever you do for one period, you should be doing a similar thing for others, and not be seen to be manipulating the numbers. So that's really the key. But if you're having to adopt a different method to what's on the BAS, there's probably a little bit of risk there, but no one can actually say don't do it. So it's just being aware that the ATO's put that out there. Look, otherwise, just to finish off with my part of it, we've listed down probably a whole lot of things that need to be done. So you're probably doing all these things, or helping your clients with all of these things. So obviously projections, we're looking at, from a business point of view, we're helping our clients with looking at projections and how robust are their projections, which goes back to the point Todd was just making about documenting what you've done. So if anybody needs any help or guidance on any of these points, happy to have a chat. As Mark's indicated, that whole question about non-STP may be a little bit tricky, because perhaps the focus has been on STP and doing things through the business portal, and which probably caters for most people, but maybe not everybody. And then as we move on, you'll get into the ongoing reporting, which is generally within 7 months of year end, as it starts to become a bit more routine. So I think probably that's enough from me, unless any questions come up. And if there's any more questions, I can come to the end. So I might just let Nick take over.
Thanks, Peter. Over to you, Nick. And by the way, everyone, there's a couple of polling questions. One at towards the end of Nick's presentation, and then one at the end of the webinar that you might like to participate in. Over to you, Nick.
Thanks, Tony. Thanks, Peter. I'll just deal with a question first. There was a question from Paul about JobKeeper eligibility for employees on maternity leave. It's a good question, and one that I've had asked of me a few times this week. It really depends on the type of parental leave that the employee is taking. So an employee will not be eligible for JobKeeper payments while receiving government-funded parental leave. So that would be the 18-week federal minimum wage entitlement, or what's known as the dad and partner pay, which is the 2-week payment from the government. But an employee that's receiving paid parental leave from their employer would be eligible. There's essentially 3 types of parental leave. One is the government funded. Then there's the National Employment Standards unpaid entitlement. So eligible employees have an entitlement to take 12 months unpaid parental leave. Some employers decide on a discretionary basis to pay their employees for all or part of a parental leave period. So if you're in those second categories, yes, JobKeeper eligible. If receiving government funded parental leave, not JobKeeper eligible. So I will do my best to not traverse some of the old ground that I've covered in the last few weeks, and perhaps just deal with a few of the issues and questions that I've dealt with for clients during the course of this week. The Fair Work Commission published something earlier this week to say that they had already received about 120 applications to deal with disputes about JobKeeper stand down and other JobKeeper directions. And that's in the first week. So that tells me that employers are either getting it wrong, or at least that employees are unhappy about being stood down or being directed to perform alternative duties or work less hours, or being required to take annual leave. All of these new powers that have been enshrined in the Fair Work Act for this JobKeeper period clearly are causing some disputes. I've been involved in a few. One of mine that I think I mentioned the last couple of weeks was about a stand down direction given by one of my clients before JobKeeper. That actually settled this week, which is good and bad. Because, I get the impression that the Fair Work Commission is pretty nervous about making a decision about whether or not an employer in COVID-19 has validly stood down their employees. I know that there is another dispute at the moment by one of the unions, one of the education unions, has lodged a dispute about a pre-JobKeeper stand down, and I think that's being heard next week. So perhaps by the end of next week, we might have some guidance from the Commission. There's been a lot of questions about the concept of one in, all in. The rules are being amended. I don't think they've made that amendment yet, but they're definitely amending the rules to make it very clear that it's one in, all in. You can't decide which of your eligible employees you elect to participate in the scheme. If you are participating and you've got employees, irrespective of their status, whether they're stood down, working or otherwise, if they're eligible and they wish to participate, then they're in. Just some comments on the payment rules. I guess these are fundamentals, but a lot of clients still concerned or unsure or requiring a bit of guidance. So clearly the scheme operates on the basis that you've got JobKeeper fortnights. They've now extended, as Peter said, the obligation to meet the JobKeeper payments for the first 2 fortnights. So basically the month of April until the 8th of May. Questions about pay cycles. So if you're not paying your employees fortnightly, say you're using a monthly pay cycle, that's still fine. You don't have to change your pay cycle. You just have to ensure that your employees have received the monthly equivalent of the $1,500 per fortnight. Also important to remember that you need to notify the ATO if your eligible employees change. And it may be that employees resign, employees are made redundant, or as the scheme contemplates, you may decide to put an employee back on that was made redundant after the 1st of March. The scheme actually contemplates that happening. With respect to the payment rules, if your employees are earning less than $1,500, you have to top them up. No doubt about that. You can't pay your employees less than $1,500 and keep the difference in respect to the JobKeeper payment. You have to top them up. If your employees are earning more than $1,500 per fortnight, you're just continuing to pay them their salary or wages. You don't have to, you can't reduce their pay. But any amount that you pay above $1,500 is not being subsidised by the JobKeeper payment. If you've got employees that are stood down after the 1st of March and you are participating in the scheme, you have to start paying them $1,500. And that's simply, a live example of this one in, all in concept. And as I said, if you've got employees that have ceased working after the 1st of March, you can re-engage them on the basis that you have to start paying them $1,500 per fortnight. I've had a few queries about superannuation. They still haven't actually, I had a look about an hour ago, There's a comment on the ATO website to say that new rules are being introduced by the government to give effect to this concept. But the concept is, if you're paying your employees less than $1,500 per fortnight, yes, you need to top them up to meet that fortnightly wage guarantee, but you only need to pay super on the normal wage. You don't have to pay it on the top up. Treasury has said that. They've also said that you can elect to do it if you want to, but you're not required to. And obviously, if your employees are receiving more than $1,500, because that's their usual remuneration, you have to pay superannuation on the full remuneration, because that's your ordinary time earnings for those employees. I've had a few queries about trying to both stand employees down, either fully or partially, and also drop their remuneration. So the JobKeeper scheme enables you to require your employees to work no hours or less than their usual hours. But very, very clearly, the scheme does not, it prohibits employers from dropping anyone's hourly rate of pay. What you can do, though, is agree with employees to reduce their remuneration. That's always been my view. There is a little bit of confusion in the way in which the rules are worded about whether or not that may be prohibited. My view is, if it's an agreement that's reached outside of JobKeeper and it's voluntary and the employee signs off on it, it's okay. What I would be careful about, though, is issuing a stand down direction and at the same time incorporating a pay reduction, even if it's by agreement. I think if you're doing it like that, there's an argument that one's conditional upon the other, and I don't think you want any suggestion that employees didn't understand that, you know, they didn't have to agree to a drop in their remuneration. Some other queries about requiring employees to work more than their usual hours if they're participating in JobKeeper, and I'm seeing this happen a lot with respect to businesses that were shut down, like take restaurants that were shut down by virtue of, you know, the government directive, then are starting to operate in a reduced capacity, say using a takeaway function. And because they're now eligible for JobKeeper, they're wanting their employees to basically work for the $1,500, even in circumstances where their usual remuneration was less than that. I think that's problematic. There's nothing in JobKeeper that enables an employer to require their employees to work the equivalent of the $1,500. And if you've got a casual employee that's currently working an hour a week, I think it's problematic if all of a sudden you're requiring them to work more hours to make up the $1,500. They're separate concepts. JobKeeper definitely enables you to require people to work less hours, but not to work more hours. Had a question about whether or not you need to treat all your employees the same as far as stand down. There are obviously businesses where some parts of the business might have work available and other parts don't. You don't have to treat everyone the same. You can require employees to work different hours, which means you can issue JobKeeper stand down directions to some employees but not others, or directions to all staff but to work different hours. It's an individual employee test. Queries about annual leave, whether or not you can require people to take leave, how much, whether you have to treat all employees the same with respect to those requests. What JobKeeper enabled employers to do is essentially request employees to take annual leave, and the employees need to agree to that request if it's reasonable. That dreaded reasonable word. But I've seen a lot of clients take that up where they're requiring their employees to take leave. Obviously that doesn't affect a JobKeeper entitlement. It just means that the employer's annual leave payments are being partly subsidised. The only rule in relation to that sort of a requirement is that the direction must not result in the employee having a balance of less than 2 weeks annual leave remaining. If you're outside of JobKeeper, you're not eligible. You need to make sure, if you're looking at directions about annual leave, to look at what your award says. Most of the modern awards will have limits on when those directions can be given. And to be honest, most of the awards are pretty unhelpful for COVID-19. Most of the annual leave direction provisions apply in relation to things like annual shutdowns, or if an employee has an excessive leave balance, like more than 8 weeks, but otherwise usually limited. For your non-award staff, your managerial or senior staff or otherwise non-award, you can issue directions if they are reasonable. And I would have thought that the current circumstances make it entirely reasonable to give a direction. Had a question about the 12-month rule for employee eligibility, a bit of confusion as to whether all staff need to have been employed for more than 12 months in order to be JobKeeper eligible. The answer is no. So the only 12-month rule is in respect of casual employees. Otherwise, if you've got a full-timer or a part-timer that was employed as at the 1st of March, they are in. Casuals are in if they had the 12-month service going back 12 months from the 1st of March. And if they are regular and systematic. I made the comment, I think, last week about, my concern about employers nominating any casual that's been with them for more than 12 months. By doing that, essentially, you are deeming them to be regular and systematic casuals, which means they have other entitlements under the legislation, entitlements to things like parental leave, requests to make flexible work arrangements, and also most of the modern awards allow regular and systematic casuals that are more than 12 months to make an application to convert to become permanents. So just exercise some cautions with respect to nominating casuals. Question about whether these JobKeeper directions are subject to other terms in contracts or modern awards. Answer is no. These JobKeeper directions essentially override any inconsistent provisions in contracts and awards. They're meant to give employers these temporary powers to issue these directions and basically ignore what's in the contract. Standing employees backup. I had a question yesterday from a client who has stood down, and this client is not JobKeeper eligible. They've got an organisation which is Australia-wide, and they've stood down a lot of their staff. They're basically educators. Standing employees back up, you don't need to treat everyone the same. So again, you can be selective about which employees come back to work. And obviously, the sooner you cease a stand down, the better as far as risk, because if the stand down is ultimately held to be invalid, you've got a back pay claim on your hands. All the states are relaxing restrictions about education at different times. So essentially that will mean they can be selective about which employees they put back on. A question yesterday about employee demands. This addresses a situation where, for example, an employee has agreed pre-JobKeeper to take a period of annual leave. And a lot of my clients entered into agreements with their clients to do that, take some annual leave as an alternative to being stood down. Now that JobKeeper's come in, a lot of these employees are now saying, well, I'd rather cease taking my annual leave. I want to bank my leave, just put me on JobKeeper. My view on that is you don't need to agree to that sort of a request from an employee. If you already had an agreement pre-JobKeeper, that survives. JobKeeper isn't a scheme which gives employees a power to choose. So I think you can insist on existing leave arrangements being honoured, as opposed to allowing employees to sort of set the rules about how they receive JobKeeper. Just to finish off, Todd mentioned at the start, businesses gradually returning back to normal, or the new normal, which is that term that seems to be bandied around at the moment. Clearly, there's going to be some really important safety issues with respect to that. I mentioned earlier in the week, one of the other presentations, that Safe Work Australia has developed some binding principles, and basically they want employers to ensure that the workplaces are ready for social distancing and hygiene measures. So employers need to start acting now to develop guidelines, policies, make it really clear to their employees how they are going to do their best to ensure their safety. And if you don't do that and have an incident, it could result in obviously a workers' comp claim or a work health and safety breach, which can be significant. Just to finish off, some questions about this COVID safe tracing app. I think Woolies and Coles, some of these big organisations have published some statements about requiring their employees to download this app in order to come back to work. What has been legislated is essentially, a biosecurity legislation, a determination that makes it very clear that it's unlawful for any person to direct or require or coerce another person to download that app. So yes, it could be a recommendation, but you cannot require your staff to download it. And you also can't treat people less favourably if they don't do that. It's a form of adverse action, which is a type of claim. So again, just exercise some caution there. That's it for me.
So Nick, that on a practical basis, you need to look at your insurance as well and understand how that fits together, and then also do some training and trying to get everybody to agree. Effectively, there'll be a union negotiation, I would have thought, with some areas to be able to negotiate those terms you're talking about, so that you can actively.
You just need to be proactive.
Structure.
Yeah, you're planning for the worst. Like in the event there is an incident, you'll have a work health and safety regulator knocking on your door, wanting to conduct an investigation. You'll need to show that you've taken active steps to ensure safety, which would be communications to staff, email, meetings, Zooms, a policy that makes it really clear, signs in the office. The more the better. Obviously, it needs to be practically realistic, but you can't just sit on your hands and expect your staff to know how to operate safely.
Do you think workers' comp's going to go up in terms of policy pricing and costs?
It's too early to say. And to be honest, there hasn't really been any published workers' comp cases, but I think there will be both physical and mental. I think there'll be a huge spike in mental health claims. That's pretty clear from a lot of the experts that people are suffering, depression and isolation issues. I think it's only a matter of time before someone tries that on and asserts that it's workplace related, which again will become a workers' comp issue.
Yeah.
Okay. A major issue for superannuation fund insurers as well, the whole mental health thing.
Absolutely.
In terms of people being deemed permanently disabled. Nick, just a question, and sorry if you've covered this, but how's workers' compensation and any claims stand in this, what we call the new work environment? People working at home at the direction of their employer, if they have a workplace incident in their house and they haven't been prepared for that, and told that they need to create a safe space or whatever it might be, does that put the employer at risk at all?
There's no doubt that the workplace is wherever you're doing work, which at the moment is home. So in addition to planning for employees to come back to work, organisations should be planning now as to how people are operating safely at home. So ergonomic assessments, having people complete checklists to make sure that they've got, a standalone work environment that's safe.
Yeah, sure. Okay. Well, thanks for that. And Betty, you don't have to talk too long.
Sorry, Todd. Sorry, Tony. Can I just jump in very quickly?
Sure.
Just a point because I forgot to add a point that I had been discussing with Nick during the week as well. So when Nick talks about the stand down arrangements, so it's actually one of our other members who was registered but hasn't dialed in, raised a question with me about paying superannuation guarantee on when employees are stood down. So. And I was pretty clear that if you had a top-up payments, you didn't pay super, but it does appear that that's the same applies to stand down, that it's not a, and that's so you'd agree with that, Nick?
Yeah, I do. You're not paying any salary. All you're doing is passing on the JobKeeper. And my reading of the Treasury notes at the moment is that the JobKeeper payment itself is not subject to superannuation. So full stand down would be no super. If you're paying part of the $1,500, you pay super on that part, but not the top up.
Yeah, so just so people have got that.
The legislation is to be released. So I guess the caveat is the proof will be in the actual legislation, but that's the guidance at the moment.
Thanks, guys. So Betty, over to you. You're going to give us a few bits of anecdotal feedback on what your clients are seeing out there in terms of how they're dealing with the banks and some of the more challenging things around getting access to unsecured funding, government-backed funding. It's not quite as simple as some people might like to think. Over to you.
Thanks, Tony. Yeah, no, it's definitely not as simple as it sounds. And certainly how your business was tracking prior to COVID-19 is a huge factor as to whether or not you will qualify for the government-backed loans. So the banks are being inundated at the moment. There's thousands of applications that are being made. So turnaround times on these are up to around 2 weeks before they're being looked at from when you apply. And also just around what the banks are looking at. So back to how the business was tracking prior to COVID-19 is an important factor. And you need to have obviously been operating at a profit. And then also just looking at the impacts of COVID-19 on your business and really detailing what you're doing to minimise the impacts. Things like, if you've laid off your staff or some staff, any rent relief that you may have renegotiated, debtors, renegotiating terms with debtors. And then it's at this point that the bank and the business can look at what the loan amount that will be applied for. So it really is to cover expenses from 3, 4, 6 months up to 12 months. Some lenders are doing. They are looking at funding a loan unsecured to cover the expenses for the next, say, 6 to 12 months. But mindful that the first 6 months of the loan, the interest is capitalised, and then you need to repay that debt to zero over the next 2.5 years. Excuse me. So it's $8,000 a month. Excuse me, sorry. I'm just going to have to take it easy because I do have a bit of a tickle in my throat. And by talking, it flares it up. So if assuming that you're applying for $250,000 because your expenses, say, for the next 12 months or the next 6 months are $250,000 and you need it to be covered, then you need to be amortizing that after the first 6 months to zero, which equates to around $8,000 a month, which is what we talked about last time. So your business in this instance would need to generate at least a minimum of $96,000 in net profit to substantiate servicing, because you do need to substantiate that you can service the debt on an amortizing basis once, with what you've got planned for your business. And again, it'll be how the business was tracking prior to COVID-19 that will also determine whether or not you have capacity for the future. So in terms of the type of business that have qualified for this $250,000 debt, I can talk about a business that was, excuse me, that sold school uniforms and imported school uniforms. So they were expecting in the month of March sales of up to around $200,000 at least. But because of COVID-19 lockdowns and schools going into lockdown, those sales didn't eventuate. But at the same time, they were expecting a shipment of uniforms that they needed to pay for. So in this instance, and that was around $200,000. So in this instance, the bank did fund them the whole shipment to pay for the uniforms that were coming in from overseas, because this business had already done a sensitivity analysis to say that, excuse me, I've got this tickle and I'm just going to keep coughing. I'm really sorry.
You're doing well, Betty. Don't worry too much.
So in this instance, the business was able to justify and say, if school goes back in June, we'll expect this much income, and so on. So and also, so I've had some other examples where I probably can't talk to them at the moment because I've just talked too much and my cough's flared up.
Yeah. Look,
but yeah.
Betty, I think in the interest of your health, we'll let you off the hook I think the message here is if you're going to the bank to seek approval for unsecured funding, you have to have a good track record. The challenges around revenue and profit guidance are there. Even the listed companies can't provide guidance at the moment. So for a small business to provide guidance when they don't even know how the government is going to wind back isolation or hibernation.
I did want to say that, Tony, I just did want to say that the bridging finance for JobKeeper is a separate facility. It is actually a bridging finance facility.
That's correct. That's completely separate to the unsecured financing.
So Tony, we're going back. It's the same process, but the problem is now you've got to have even more robust and conservative assumptions so that the bank can assess it so that they know that, and they're going to take a leap of faith to a little extent compared to where they were previously. But if you can't give them any of that, they're unlikely to want to play.
Yeah, you need to have a really good strategy as to why your business will to return to how it was before COVID.
Yeah, look, and I think the banks will obviously understand that trying to put a number on, trying to compare previous revenue and profits to where they might be in 12 months is challenging because nobody knows how businesses are going to come out of this and when they're going to come out of this. Betty, you've done well. Sorry to put you through that. I'm sure our HLB community members appreciate your guts and perseverance, but that's some good anecdotal feedback. And please reach out to Betty if you need some guidance around how the banks are looking at these things, because she and James McFarlane, the debt advisory team, are there to help you, because it's something that's definitely not as easy as it might appear, and it does take some navigation.
Excellent.
All right, well, I think
Thank you so much.
Yeah, thanks, Betty. Look, I think we're pretty well done. Thanks to everybody for attending today. We will be having another update next Friday, and we welcome you all back. Look, it may well be that there's another polling question there too. There may well be that we add a few different things into this weekly update now. Todd and I and Nick and Peter will have a chat about that. But we wish you all well. Please stay in touch. We're here to help you when you need us. So without further ado, I wish you all well and have a wonderful afternoon. Thanks for joining us. Bye-bye.